Hey guys, what's up? I'm Erin and welcome back to the channel. Big tax changes could be coming for our seniors. On February 17th, two new bills were introduced in the House of Representatives proposing big tax savings for American retirees. The Bonus Tax Relief for America's Seniors Act and the Tax Relief Unleashed for Seniors by Trump Act both aim to put more money back in seniors' pockets by cutting their tax burden. While their goal is the same, these bills take a different approach in achieving it. So let's break down exactly what these bills propose and, more importantly, how much could seniors actually save if they become law? Let's break it down. The Bonus Tax Relief for America's Seniors Act aims to increase the additional standard deduction for seniors age 65 and older. As it presently stands for the year 2025, the standard deduction looks like this. Single filers are entitled to a $15,000 tax deduction. Those married and filing jointly are entitled to a $30,000 tax deduction, and head of household is entitled to a $22,500 tax deduction. Those numbers are indexed for inflation and do adjust upwards on an annual basis. As it stands today, for America's seniors, those age 65 and older, they are eligible for an additional deduction on top of the standard deduction. For 2025, single filers 65 and older get an extra $2,000, bringing their total standard deduction to $17,000. Married couples filing jointly receive an additional $1,600 per qualifying individual, so if both spouses are 65 or older, their standard deduction is $33,200. The proposed legislation aims to increase these deductions significantly. Single filers 65 and older would see their extra deduction jump to $5,000, raising their total deduction to $20,000. Married couples, if both are 65 or older, would receive a total of $10,000 in additional deductions, bringing their total standard deduction to $40,000. The goal is to lower the taxable income for seniors, lowering their tax liability and allowing them to keep more of their hard-earned money. The second bill that was proposed, titled the Tax Relief Unleashed for Seniors by Trump Act, aims to reduce federal income taxes on Social Security benefits, allowing retirees to keep more of their income. Currently, about 40% of Social Security recipients pay federal taxes on their benefits, and how Social Security ends up being taxed depends on provisional income, which looks at half of your Social Security benefits, as well as other income sources. Let's consider how Social Security is taxed today. For single filers, if income exceeds $25,000, up to 50% of benefits may be taxed, and if income exceeds $34,000, up to 85% of benefits may be taxed. For those married and filing jointly, if income exceeds $32,000, up to 50% of benefits may be taxed, and if income exceeds $44,000, up to 85% of benefits may be subject to tax at the federal level. This new proposal aims to increase the threshold before Social Security benefits are subject to tax, meaning fewer people would likely pay taxes on their benefits, and those that do would likely pay less. One of the biggest criticisms of these income thresholds is that they were set back in the 1980s and were never adjusted. And as inflation has increased incomes over time, many retirees find themselves paying taxes on their benefits. This bill addresses that issue. Specifically, it proposes doubling the current exempt income from $25,000 to $50,000 for single filers and from $32,000 to $64,000 for married couples filing jointly. If you're at all curious as to what happens from the tax revenue generated from taxing Social Security benefits, for the revenue generated from taxing 50% of Social Security benefits, it's funneled right back into the Social Security trust reserves. And for the revenue generated on the 85% tax bracket for Social Security, well, that gets directed to the Medicare Hospital Insurance Trust Fund. If you want a detailed breakdown of how income levels are taxed and how provisional income is calculated, I have an entire video covering this topic, and I will link it here if you're interested. Both of these bills were put forth by House of Representatives member Nicole Malliotakis, stating our seniors have worked hard and paid taxes their whole lives, and they should be able to keep more of their Social Security and retirement income without Uncle Sam trying to reach into their pockets again. Going on to say, many of our seniors have been crushed by inflation and are being forced to stretch their retirement savings further than ever before. The bills I'm introducing today would reduce the tax burden for our seniors and keep more money in their pockets and allow them to retire with greater financial security. Now, if both of these bills were to become law, what kind of impact would that have on our seniors? Well, let's run an example to find out. Let's say we have a couple, Dylan and Carol, who are each 65 years old, married and filing jointly. They have a household income of $120,000 a year. We'll assume they each earn $1,900 a month from Social Security, giving them an annual household income from Social Security of $45,600. The remainder of their household income comes from a withdrawal on a traditional 401k amounting to $74,400. Not all of Social Security benefits are subject to federal taxes. It could be up to 50% of benefits or up to 85% of benefits when income exceeds certain thresholds. In this example, for this household, 85% of their Social Security benefits would be subject to tax, resulting in a taxable amount of Social Security at the federal level of $38,760. Being that Dylan and Carol are making withdrawals from a traditional 401k, the entire withdrawal is subject to ordinary income tax. So ultimately, to determine their total taxable income, it's the 401k withdrawal, the $74,400, plus their Social Security subject to taxes, in this case $38,760. Then we subtract their allowed standard deduction, which in this case is $33,200, leaving us with a final taxable income of just under $80,000. This amount falls in the 12% tax bracket, leaving them with a total federal tax liability of about $9,400. So this is our baseline. This is what their federal tax liability would be under today's rules, the current standard deduction and the current manner in which Social Security is taxed. But let's take a moment and assume that both of these bills get passed. We now have a higher standard deduction and higher income thresholds for where Social Security becomes subject to income tax. So let's run the example again using the same scenario, but assuming both of these bills have been passed. How would that change their federal tax liability? In this case, Social Security benefits would be subject to higher income thresholds. In this case, about $28,000 of their Social Security benefits would be subject to tax at the federal level. Their withdrawal from a traditional 401k of $74,400 is subject to ordinary income taxes. Add in the taxable Social Security benefits, then we would deduct the higher standard deduction, now $40,000 if this bill were passed, leaving them with a taxable income of about $63,000, giving this couple a total tax bill of just over $7,000. So with this example, we end up saving Dylan and Carol about $2,300 in taxes. Different types of income are taxed at different rates. In the example we used with Dylan and Carol, their entire withdrawal came from a traditional 401k, meaning the entire amount is subject to ordinary income taxes. And ordinary income tax rates are among the highest tax rates we have. If they had a Roth account, the withdrawal would come out completely tax-free. On the other hand, say they had a traditional brokerage account, it's likely that this withdrawal would have more favorable tax treatment because it might be subject to long-term capital gains tax. Ultimately, every retiree has a different portfolio, and understanding how these different accounts are subject to different tax rates can go a long way to reducing your tax bill in retirement. So in the spirit of that, let's do one more example, and we'll assume they still have this $120,000 income, but we'll assume when we look at their investment withdrawals that 50% is coming from a Roth account and 50% is coming from a traditional account. We will assume the Social Security benefits are exactly the same, $1,900 a month per person or $45,600 for the year, and that $37,200 comes from a Roth, and $37,200 comes from a traditional 401k. In this case, their taxable income at the federal level would be $23,600 once we factor in the standard deduction. This would put them in the 10% tax bracket, and their total federal tax bill for the year would be about $2,300. Keep in mind, this is how things would be taxed today under the current rules that are in place. I think it's important to look at these different types of examples because it highlights the true importance of having different accounts to draw on in retirement and how that really can affect your tax liability. Now, let's do the example one more time, assuming both of these bills pass, that the income thresholds for Social Security subject to tax have now been increased, and that the standard deduction for those 65 and older married filing jointly is now $40,000. In this case, the couple's withdrawal from their Roth account would not be subject to taxes. Their Social Security payments would be subject to higher thresholds for determining taxable income, leaving $0 of their Social Security subject to tax. So once we factor that in with their withdrawal from the traditional 401k and after applying the standard deduction, their federal tax liability would be $0. If these two proposals become law, they could absolutely amount to significant tax savings for retirees, increasing the income thresholds for Social Security subject to federal taxes, and increasing that standard deduction could allow seniors to keep more of their hard-earned money. This could result in savings of a few $100s for some to several thousands of dollars for others. What are your thoughts on these proposals? Would they impact you if you're in retirement? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Retirees. Americans retirees? No. I reused seniors twice. I don't want to do that. Okay, friend. So let's break down, which looks at about half of your, don't say the word about. Okay. Well, that goes to the medical representatives member, Nicole. I don't know how to say her name. I gotta go find out how to say it. 9,000. It's a bad place to get stuck, isn't it? Mute your computer. Why do I do that?